There has been a lot of talk over the last 24 or 36 months. And if you ever want to step back further to the Great Recession, about institutional buyers. For a long time, it was often believed that institutional buyers would not come to single family homes because you couldn't get scale. Well, after the Great Recession, that proved easier when they can buy entire books of business in foreclosed properties. You've seen companies grow quite large, like American Homes for Rent and other Invitation Homes. Then come down the pipeline, we generate a new thing called iBuyers, and iBuyers went nuts. But you know what? Something strange has happened over the last, I don't know, 6 months or so as rates have gone up and iBuyers have left the building. Institutional buyers are down 90%. This comes from the one and only Lance Lambert, who drove into this, who is a featured writer on Fortune magazine, and we are lucky enough to have him back each and every week. Lance, how you doing?
Good, Michael. Thanks for having me. Housing, housing, housing. Always a lot going on.
Yeah, so you've done an excellent report on institutional home buyers, and I just want to sit back and listen and really look at what you've uncovered, because some people think as institutional buyers go, so goes the market. Others may not think that, but let's talk about what's actually happening with the data.
Yeah, let me pull up some of the charts real quick here. Give me a second. Minimize some of this stuff. And give me one more second. I'm going to actually pull up some of the screenshots real fast of these charts.
Perfect. Yeah, and again, these screenshots are really going to focus on institutional buyers, and those are folks that have over 1,000 units, or where does that line go?
Yeah, that's how John Burns Real Estate breaks it down, is they classify them as 1,000. To me, I don't think it necessarily needs to be that much. Like, I talk to Yield Street a lot, and they have like 750. And to me, they're an institutional buyer because they're chasing yields essentially.
Correct.
Um, it, and so let me get this one more to go. And while I'm pulling these charts up, what we've seen on the top line, according to John Burns Real Estate, well, they've changed their name now. I think it's John Burns Consulting and Research. But what they've showed is that in the first 2 months of the year, January and February, there was 90% less institutional buying in the market. When you go down to like mid-sized investors or the smaller ones, especially the smaller ones, there hasn't been anything close to that in terms of a pullback. And the reason there being is it's about yields. Just like when we see stocks move down when there's a correction, let's say the Fed's jacks moves up 25 basis points, right? And the market wasn't expecting that. Well, the reason the market's pulling down like that is about yields. They're chasing yields. They're moving into different asset classes. And the same thing happens in housing from the institutional side. They pump money into it when their math thinks there's going to be higher yields. And that's what we saw during the bottom of the crash is they realized, oh, housing has not only corrected, it's actually overcorrected.
Yeah.
And that's what the crash was. It was a correction and then actually an overcorrection, where on a real basis, homes were cheaper than like the past 50 years at the bottom of the crash.
Yeah, 2010 was the best year on record to buy in the last 53 years. 2010 was amazing.
Yeah, and so that combined with the fact of demographics where millennials were moving into their rental phase, right?
Mhm.
And it was, you were going to make so much money on the prices moving up and so much on rental growth that it just made a lot of sense. So we saw a huge dive in terms of the buying then, right? That's when like the Invitation Homes, they were building up their portfolio across the country. And it kind of slowed down over time. But during the pandemic, we saw another boom, and I'll show those charts here. Okay, here we go. So on my left, I have Invitation Homes. They own 83,000 single-family homes across the country. You can see during the early period of 2020,
Mhm.
It's kind of a mixed bag, right? That's when we're at the COVID-19 recession. And then they kind of realize here, oh, housing's going to is going to rip. And
Yep.
so you had easy access to capital, you had very low interest rates, you had extremely high home price growth and extremely high rental growth. Everything. That's all
Yep.
that you want. The cap rates were amazing. And so they're buying them up. The mortgage rate shock occurs, they pull back. And actually, this first quarter of this year, Invitation Homes sold more homes than they bought. Now, I don't know necessarily how long to expect that trend to hold, right? And there could be, some other factors at play there, but they are a net seller in the first quarter. And then we look at American Homes for Rent, and same thing. There was a slowdown in terms of the buying during the COVID-19 recession just initially. Well,
Mhm.
actually, not really for them because that first quarter they're going. But then they really took off as home prices started to rent or rip and rent started to rip. And then now they're actually a little bit more of a net seller than Invitation Homes.
Yes,
And
it's really that would be something that would be really fun to uncover from both of these, and it's only going to be a guy like you that can do it. Is to figure out why they become again just at least one quarter really net sellers. My guess, just an experienced guy's guess, is they're trying to pick which markets to stay in and which ones to exit. It's just a wild guess. I have no
I,
data to
I,
back
I
that
think
up.
that makes a lot of sense. And, I was looking through their portfolios, and I don't know if it was Invitation or American Homes for Rent, but one of these guys has 10% in Phoenix. At some point, you got to, like, they're
Yeah,
kind
you're
of in these high growth, what
yeah.
was high growth markets over the past decade, the Southwest and South. And I don't know, maybe they just kind of got to sprawl out more,
Yeah.
like
Yeah,
you said.
concentration that high could be risky, especially in a market like Phoenix that has boom and bust cycles. But I think it's really interesting because when you
Stable
hear 90,
markets
go ahead.
stable markets like Milwaukee with
Mhm.
inventory that's so low, Columbus,
Yeah.
Indy, and they're still kind of growth markets population wise. So I could see them making plays there eventually. You were
No,
saying?
that's exactly what I think happens is these big, institutional buyers, we're calling them here. They're this first half of the year, my opinion, is portfolio analysis. Where are we over concentrated? Where do we want to kind of reduce our footprint? But also probably where are we going to go harder, i.e.,
Mm.
the Milwaukee's and in those. That's what I would suspect is going, because some people are playing this up like institutional buyers are leaving the market. Single families don't make sense. And that's just not the case. This is a market by market analysis going on. I believe Invitation and American Homes will have more houses in a year than they have today. The mix will be different. And some people are overreading. Oh my God, they're net sellers. Time to leave. The world's crashing. Run, run, run.
But I do think it is true though, because they're chasing yields. Like Yield Street,
Yeah,
their
of
name is
course.
literally Yield Street, and they're chasing yields. I think some of these safer asset classes, even like CDs being higher right now.
Yeah.
I think that has a bit of a short-term impact on them. But yeah, I mean, you look at these, it's not like last year Invitation Homes was just offloading their portfolio, right? It looks like they've just kind of hesitated, is what I kind of see there. And that story I did over the weekend, JP Morgan Chase's
Yeah.
asset home, they just bought that community down in Orlando.
Yeah, I
Um,
saw that. It was well done.
yeah, and Orlando's kind of a fairly strong market. I was talking to the build for rent developer for that community, uh, and he said that in January uh, or in December they were getting good deal offers from or some of the institutional buyers were getting good deal offers down in Orlando to come in. And he knows in one case of, an institutional buyer who was talking to them. And then January, the sales started going, and they're like, yeah, sorry about that.
Yeah, no, never
uh,
mind.
and another thing that he said is some of the institutional buyers were prepared in like the middle of January to start pushing more into the market. And then
Mhm.
rates got firmed up again. There was that moment. You remember the
Yeah, I
5.9.
do. 599.
Yes. And I think that's probably what he was talking about, that phase there. And so I think that also tells us that like rates move down, as rates move down and these yields can improve, I think you'll get more of these institutional buyers back in the market.
Well, again, I keep telling folks we actually have multiple data points that 6% is the number. And we also know that 7% stops the market, right?
Yeah.
So again, we have evidence of it. So, I am one that
The
happens
interesting
to,
thing is that rates have decided to do neither, and they're kind of
yeah,
doing 6-7 to 6-4. It's like watching
exactly.
a little ping pong match. And I never know to make like I don't want to ever make a big deal about any of these moves because like today, like we're at 6-7, and we're probably going to go a little above that, maybe set a 2 month high today. But it's like every time that we've done this, and we do it every 2 weeks, it goes right back down
Exactly.
to six
It goes
four.
right back down.
And then it's I kind of like Logan over at Housing Wire's Gandalf line with the 10
Yeah.
year because it
3.73 or whatever it is. Yeah.
it has, and we'll see news like a jobs report or the inflation numbers or the Fed says something, and it moves the
Yeah.
market. But it keeps going right back to that point right now. I
Yeah.
guess it'll be interesting to see what happens when we get a real pause.
Yeah. And I
Um,
think that one's coming in June. But I think where this is going is I'm hoping you're going to be looking at institutional buyers probably throughout the year, because I think what you're seeing now is a pivot in their business from markets to markets. And, this last quarter where they were net sellers, both of them, I think it won't be that way all year, I'm guessing.
yeah, I think that makes a lot of sense.
Well, Lance, do me a favor. Where can people follow you on Twitter? Because I follow you every day and talk about you lots of times on the daily financial news. And then where can they find your articles?
Yeah, they can find my articles, Lance Lambert, Fortune. If you just Google it, pop right up. Twitter at News Lambert. You can find a lot of my stuff. I tweet out charts like this all the time. And last point before we jump off, I tweeted this out earlier. Existing inventory constrained, institutional home buying constrained, new home sales improving. I think those are three of the things we've seen this first quarter
Amen.
kind of held true, and we'll kind of see as the story unfolds this year.
Lance, thank you so much for coming back each week. I can't wait for topic number 2. Thank you.